Hey everyone, and welcome to the Bricks, Bucks, and Bytes podcast, your weekly dive into funding, market, and investor news in architecture, engineering, construction, and supply chain. Before we get started, a quick announcement. If you're a founder, construction tech enthusiast, or responsible for innovation in your company looking for exclusive insights and content not found anywhere else, you won't want to miss our newsletter. Head over to www.bricks-bytes.com and sign up today to get cutting-edge material delivered straight to your inbox. In this episode of Bricks, Bucks, and Bytes, we unpack Coast's $40 million Series B raise. We examine Fundamental's Q2 VC funding statistics and explore why construction tech is bucking downward trends in late-stage funding. And finally, we challenge Didi Duss's claim that employee headcount growth is the best signal for identifying promising startups. And now for the episode. Good morning, everybody.
Hello.
Good morning.
How are you enjoying the peak of summer?
Where is the peak of the summer? Here, where I am, or you are, or Patrick is? I don't see a peak of the summer behind the window.
I like fall.
Very nice. Where the trees go yellow.
Yes. And more like 18 degrees centigrade, not 25.
Yeah, nice. Okay, guys, so today on Bricks, Bucks, and Bytes, we're going to discuss a startup that describes itself as a financial services platform for the future of transportation, and it's just raised 40 million in Series B funding, and apparently just 4 months after, not raising, but announcing a $25 million venture round and 67 million in debt financing. And then for the market news, we'll be focusing on the state of AECS and ConstruTech in Q2 2024. Patrick, any teasers for people on this before we get into it?
We're on track. We're trending up and to the right.
So we like to hear. And investors' take will be on whether employee headcount growth is a powerful signal for Series B plus startups. And this is something that Patrick has confirmed he fundamentally disagrees with. So, Martin, you want to kick us off?
Yes, so we have Coast, a startup that describes itself as financial services platform for the future of transportation, and they raised 40 million in Series B, 4 months after previous raise, 25 million venture round. I'm not sure if this was the same series or this is different series, and if yes, then seems like quite a lot of money raised a few months after the previous one. So that's interesting to find out, Patrick, what you think about this and why was that the case. But in terms of the technology they provide, I guess they serve payments for various types of companies, not necessarily related to construction, but in logistics in general. Is that correct?
Not entirely. So they do target the... So for morning guys, they do target the helping with the logistics side of contractors and contractor-related craftspeople businesses. But you're right, they wouldn't help on the construction side or on the job side. They would help with the basically logistics and supply chain around that, and specifically with the expenses for and helping with managing the expenses for the logistics. And so the way Coast works is it's not very unique model, actually. It's a model that has been around for a few years. It originally started in generic expense management and generic expense cards with companies like Brex, for example, that was targeting mostly white-collar use cases, where Brex, in a nutshell, if you dumb it down, basically said, hey, you have, as a white-collar business, all these credit cards floating around, or you have all these cash payments, cash outlays of your employees floating around. In the simplest case, it's a restaurant payment. In the hardest case, or in the most regular case, it would be, for example, travel. And Brex basically issued virtual credit cards to businesses, and then put a software on top to actually see the spend, manage the spend, set budgets, set permissions, basically build an entire workflow around managing the expenses of your organization in a white-collar context. And then as time went on and the model really worked, we saw more and more verticalized. Brexit, so to speak. And originally, we have seen it in the US, for example, in a company called Flexbase, which is targeting SMBs, including construction SMBs, but not specifically going after the logistics use case, more broadly going after the expense management. And this is where Coast takes it a step further. Coast actually goes both vertical as well as super specific on the logistics use cases. So what they do is similar to Brex. They take expense management as their target for logistics, and they start with fuel cards. Fuel cards is something that, for example, A2V has also done in the US, but for the trucker vertical. So with that, basically, Coast combines both Brex and A2V and A2B, and combines them and says, hey, dear landscaper, dear contractor, dear HVAC installer, through our software-enabled platform, you can give out very easily fuel cards to your employees. These fuel cards have limits, they have permissions, you can see how they are being used, in what place. And most importantly, there is a network of onboarded gas stations with deals behind that. So you actually get into it's not technically group buying, but you get group buying discounts because you actually aggregate volume behind the suppliers that want to tap into the customer base, of course. And so that's what everything starts with. On top of that, you build expense management software that Coast has built. And you can do a few neat other things that I can tell you about, but this is in this essence what Coast does.
Mm-hmm. Interesting. So they said that they 10x'd in both annualized revenue and payment volume in the last 18 months. That sounds kind of insane, right? Or not really for
That's very good for this stage. Yeah.
Yes.
Yeah, and apparently that's what led to existing investors doubling down on the company, and they also got some new investors. I think I read that it was co-led by Axel and who was the other company? Inside Partners?
Yes.
Yeah.
Axel Inside Partners, Vessay Ventures, Avid Ventures.
So those were the ones that did the previous round. And so this round was led by Iconic. Iconic is a very legendary investor in the growth stage. They originally emerged, I want to say maybe 15 years ago. Their claim to fame was that they took, for example, the family office money of Mark Zuckerberg and his wife, and then a few other high net worth individuals. And they have grown a very large multi-stage fund in the last 15 years, and quite successful, I have to say.
Mm-hmm. So what startups what environment startups need to find themselves in to be able to generate such a large growth in terms of revenue and customers, perhaps?
It's always instant outcomes. I keep coming back to that, Martin. You know that it's always instant outcomes. So in our industry, which Coast is targeting specifically, when you can deliver someone an instant outcome, ideally wrapped in a service or something that does not, if it's not a service that does not require any training, any onboarding, any infrastructure changes, you already have one of the most important ingredients. Secondly, I think what Coast has done well here is the targeting of workflow at the intersection with a vertical industry. And our vertical industry, I keep telling people, is not an operations business. It's not an operations business. It is a project business. And because of that, it gets optimized through the supply chains. And so that's where Coast sits, right? If you think about it. Yes, it does look like, hey, it's a logistics use case, but it's the entire supply chain in terms of how do I actually stock my car that I need to take to the job site? And how do I give my employees the financial supply chain to make on-the-spot purchases? Because Coast, beyond the fuel cards, is also going in allowing generic purchases with generic expense management and expense cards, the way that Brex originally did it. And then you can actually do all sorts of neat things on top of that. So for example, in Asia, we have a portfolio company called Loconav that Sequoia then invested in. They do very substantial double-digit million revenue. They are almost net profitable, and they do almost like for like what Coast does, but a little bit more broadly targeted. So they would have contractors, but they would also have generic SMB truckers in there. And the one or two things that they do on top that Coast hasn't done yet, but I expect Coast to do, is they allow you to purchase spare parts for your fleet. They also do the insurances. They also do the toll road registration and automatic toll road payments. All of these are things once you sit in the logistics stack and the supply chain stack of the contractor.
And the way they make money is that they take the cut of these expenses by some sort of form of partnerships with vendors?
Exactly. It's a credit card model.
Is there any competitor? Because I guess they are US based and they are.
So you would, yeah. So I haven't seen one that is targeting the intersection of expense management, starting with fuel cards, and specifically construction and installer SMBs. So that intersection, super specifically, I've not seen. But once you remove the targeting of the construction, you will probably have 10 different competitors, starting with Brax. Ramp is another one. FlexBase is another one. Once you remove the expense management and you say, hey, let's go after fuel cards specifically, then A to B would be such an example.
Mm-hmm. It's interesting.
Do you think that the success of this company and what they provide would have been obvious before it was launched? Like, is it obviously a good to target a like a brick style for construction before perhaps Coast was obviously you can see now that it's been quite successful based on fundraising metrics and a 10x annualized revenue. Do you think that this would have been obvious? Patrick, maybe you could refer to your framework slightly.
Yeah, it's a great question. So in Fundamental, the framework that you're referencing, Owen, is we call it the hidden in spite of obvious framework. So think of a 2x2 matrix. On one end, you have the experts, the industry insiders, the customers of construction. On the other axis, you have, generic people that usually deal with other sectors. And so to the top right, you would have opportunities that are hidden to the generic people, but obvious to the insiders. Like that's a sweet spot where ideally you would sit. And so your question where this one sits in the framework, I do not think it was hidden in spite of obvious. But I also do not think it was obvious. For the simple reason that oftentimes, and this might be the case here, people shy away from, by people I mean generic investors or generic founders initially shy away from what they consider a niche. And when they don't really then continue doing the work on the niche, they might just not go into this use case here that Coast is doing because originally they think, this is too niche, I need to be broader, etc. But then once you spend the work and you feel like, hey, actually, maybe this is just a random number, 5 billion market, but it might be a market where I can get 50% market share. So when you do that kind of work, you might be the only one in your niche, and it might be this kind of opportunity.
That's interesting. So you would say then that, so I agree that niching down into a particular vertical, much easier to gather customers and provide better suited product. But there is obviously the ceiling of the reach that you can have because of the definition of the particular market, right? So from investors' point of view, is it not a constraint to a degree that these guys are only focused on construction related fleet operators?
So look, every business in the world is constrained to a degree. The question is just how high is the ceiling? And the question that you should ask yourself as an early investor, and even a Series B is still fairly early, right? So it's not like the story of the company has been written. You also need to consider, okay, how can I do my TAM expansion, the expansion of my total addressable market? And that's something that is actually quite neat. And why I was giving the examples that I was giving is in this kind of business, you will find more and more opportunities to take more and more spend and spend management headache from your customers. The next one is going to be the maintenance of the fleet. The next one is going to be then spare parts. The next one is going to be insurance. The next one is going to be tolling. And so that way you're actually constantly expanding the TAM without new customer acquisition costs, because the customers in construction tend to be super sticky because they hate switching tools. They hate switching solutions.
True. Okay. So maybe some thoughts on the money part of it. So 40 million Series B, just 4 months after announcing 25 million venture round of 67 million. So that sounds like a lot, but what do I know? And very close from the previous race. So any thoughts on this? Why was it so close to previous round? And
also, just 1 point, just to state that the total amount of funding now, according to Crunchbase, is 165.5 million.
Seems like a lot. Yeah.
Yeah. Significant.
Because I guess the only tangible thing they would provide you with is a card, right? Which is, yeah.
Multiple cards, because you can also have the expense management now.
Yeah.
So that would be a different kind of card, because the fuel cards are always bound to just using it on fuel spend, and then usually only at pre-registered gas stations. Yeah. So that's quite limited, but intentionally. The expense management, it would allow you to also do other purchases. For example, purchases that nails, dowels, that would be a classic example for a construction company that you could also do then on the spot, more or less.
Mm-hmm. Cigars.
Look, I mean, I haven't talked to Coast for this round, also not for the previous round. But I've just been doing some head math, which means I don't have any inside knowledge here. And if I did, I wouldn't share it. I'm just doing an outside-in ballpark information, right? So they are saying they have issued over 100,000 cards. Let's assume all these cards are actually active. Mm-hmm. Let's assume they make 500 GTV, so gross transaction value per card per month. That would give you 600 million of gross transaction value, GTV, right? And so if on that you're then earning 1.5%, that puts you at 9 million net revenue run rate for this kind of business, right? For that to have raised 150 million is certainly on the upper end, but it might be the growth rate as well as the gross margin of this business that could entirely justify what they are doing. We have another portfolio company that is a cross-border payments infrastructure for industrial goods, construction materials, etc., that is running a similar model, and it's growing like crazy. Once you have built the infrastructure and once you have figured out the distribution motion, you're entirely set to grow extremely fast. And of course, on every transaction, then you make a hypothetical 1.5%. It could actually be higher, by the way. I've also seen businesses like this get 2%. So it could absolutely be justified by growth margins. The initial scale, perhaps, if it were 9 million and not growing 10x, but 2x, then I don't think they would have raised this round.
Mm-hmm. Interesting. Does Patrick, from a
again, these were hypothetical numbers. I don't know the numbers of the business.
Yeah. Mm-hmm. When a company gets to this stage as like a series, I think we'd refer to it as Series B plus, Series B.
Yeah, Series B.
Series B plus or something. And then partners like Iconic and Axel and Insight partners like big names are on the sheet. Is this like for other investors, if they get involved with the deal, with like bear in mind where we are, Series B with good investors, is this like how does it feel as an investor? Is it like do you feel like you maybe have hit the lottery already, or
so maybe not lottery, but it is definitely used as a sign of curation. And what happens behind the scenes, I've had these discussions a lot from other investors. Hey, let's get this deep-pocketed investor on board, because if at the next round we hit adversity, they have more money. Huh. That does happen a lot. Which, by the way, is in my opinion actually problematic and not good, but people think it's good.
This is scarcity thinking, honestly. So that cannot be a good outcome out of that.
And then there is behavioral economics kick in. And the best way to describe it is the Spider-Man meme, where there's 10 Spider-Men pointing at each other, and nobody is actually moving. I've seen these situations more often than I would like with founders. No, you move. No, you move. No, you move first. Okay, then I'll move. And so that's actually not necessarily good. But to your question, yeah, people consider this usually good. I personally consider this a neutral signal. It doesn't tell me anything, to be honest.
So you think that the best is, maybe not you think that the best, because I'm trying to frame your thoughts, but so would be the ideal scenario is where there is one leading investor and some others are not leading, kind of?
No, for me, the ideal scenario is that I know the partner of the firm, and the partner of the firm is an expert in this kind of business. They are being thoughtful. They are not giving harmful advice. They have a steady hand. They don't get moved or shaken by short-term movements. So I look for specifically a partner, a person that I can trust, and I get excited by that, not by the brand at all.
What about, given that we are going to jump onto this topic soon, Series B, employee headcount? We will get there, but just making a joke to future topics. Shall we move to our market news?
Here we are.
Let's do it.
Yeah, so you guys, you and Gabe, I guess, wrote an article about the state of AECS tech and ConstruTech in Q2 2024 and VC funding statistics. And
But
obviously,
Martin, now that you know how to zoom, do you want to just zoom in slightly?
sorry?
Don't freeze under the pressure of the recording signal. Oh, well done. Okay.
Oh yeah, that is zoomed.
Yes.
Yeah.
Right. My favorite number from this article was, I think that we are right now at 0.58 or 53.
53.
53% of the total venture funding within construction tech. Yes. So Patrick, over to you. What is that about?
Yeah,
So
I
we
think,
do this-
Patrick, sorry, 2 seconds. Could you just give us an overview and then we'll dive into details?
So we do this analysis every quarter. Briefly after the quarter ends, we analyze the number. So we have to work with the numbers that are publicly available, and unfortunately, that is funding statistics. I say unfortunately because funding statistics actually are not a great signal to use or indicate any kind of quality. But if you then elevate it to the most macro level, it actually works a little bit better than it would work on a specific company or a specific asset, because it does tell us how, in general, capital is allocated to our sector. And then if you track how it changes, that's really insightful. And so that's what we're doing here. Every quarter, we analyze from Traxon numbers. We also double check with Crunchbase, but the source is Traxon numbers. The capital allocation into the AECS, architecture, engineering, construction, and supply chains sector. And so to start off with the number, Martin, you were referencing, if you can scroll here a little further, is basically the market share. What is the market share of ConstruTech funding as a percent of the overall venture funding that happened in Q2? And that number is indeed now 0.5%. And that doesn't sound a lot, but keep in mind, it is competing with a ton of other sectors. It's competing with retail, fintech, logistics, prop tech, mobility tech. So we're in competition here, which means we're right now 1/200th. That is, by the way, if you take the percent of the global construction industry of GDP, which is 10 to 12%, it kind of shows you that actually it is underinvested, it is underrepresented. But what's more interesting is what you see here is actually the change and the rate of change by which this market share has developed. And so originally, 4 years ago, prior to the crazy year 2021, we were at only 0.1 to 0.25%, which means we have doubled and we're constantly trending up. And also the floors of the market share that we have every quarter are getting higher and higher and higher. In Q2, we were already at 0.6%. We already had one quarter where we were 0.8 and 1% of the global VC market share. And that is trending. We never had these peaks a few years ago. And so that to me is a very important indicator that tells me that, hey, actually capital allocators are spending more and more money into our sector, and money is self-perpetuating in a way. The more you allocate, the better people come. The better people come, the more customers adopt. The more customers adopt, the more money gets allocated.
What is the floor of 0.6, as you mentioned?
So what I mean by that is if you look at the peaks prior to 2021, right? So the peak was 0.5%. Now, actually, our lowest quarter after 2021 is usually around 0.5%. We had this one outlier in Q1 this year, which was 0.1. But overall, if you look at this chart, you see that we're actually, the lowest that we get is always 0.4, 0.5%. So we're constantly raising the floor. That's what I'm saying.
Got you. What's percentage on annual basis of this increase of the trend line or average kind of?
So I haven't done the annualized one, but it's 2x over 4 years.
Yeah. Okay.
Okay. So for the people like me that like a more qualitative conclusion of the 0.53%, this is a strong signal that people are interested in the industry, and that let's say we call it growth will continue.
Personally, I think so. Absolutely. I actually think we're only at the bottom of an impending inflection.
Very good. So we can add maybe some more points within the report, man. $34 billion in funding. I suppose it goes hand in hand with what we just mentioned. Maybe.
Yeah,
so
exactly.
34 billion in VC funding. This is in total, right?
Correct.
So I think last time, Patrick, when we done the podcast with you back in Jan, or we were like 30 billion, and maybe that was
Correct.
based on previous statistics. Yeah. So there's been a 4 billion. Hey, listeners! I want to take a quick break to remind you about the Bricks and Bytes newsletter. If you're interested in learning about the technology shaping the future of construction, you won't want to miss the valuable insights we share each week. To get this exclusive content delivered straight to your inbox, head over to www.bricks-bytes.com and sign up today. Link is in the show notes. Back to the show.
4 billion in 2 quarters.
Yep.
2 billion.
And by the way, I should mention one thing because I just want to make sure everybody gets the context right. I actually, when I do these numbers, I eliminate 4 outliers that otherwise these numbers would not be 30 or 34. It would already be 40. So I eliminate Katerra, I eliminate Vue, I eliminate Halo, and I've eliminated a 4th one, which actually was an outlier. You can see it in my source data. So I actually eliminate these. If I were to include them, the numbers would be even crazier.
Mm-hmm. Cool. And I guess what's also quite interesting is that it's counter-cyclical. What with the numbers that we're seeing compared to other industries.
Exactly. I find that fascinating. So we were just discussing the Series B of Coast, right? And so Martin, if you could scroll to the line chart at the bottom. So in the line chart, we're comparing how do the round sizes in construction tech and in generic venture, how have they developed year over year? Go a little bit up, Martin. It's one above that, I think, the line chart.
There's one? No.
Sorry, one more, I think. And so we compare the seed rounds, the Series A rounds, and the B rounds. This one, thank you. And so on the left-hand side, you see the early stage, which is seed A and B. And you can see that, hey, actually, construction tech is developing sort of in lockstep in terms of round size with the general VC industry. And seed rounds, actually, our seed rounds are larger than they used to be 10 years ago. Then the generic venture in A's, B's, they are also larger than they were 10 years ago, but actually the generic venture is even larger, right? So, but in general, it's lockstep. But the right side here, the growth stage, Series C+, that's super fascinating analysis. And I did not expect this result because the expectation was that for all venture industry, the size of the growth rounds plummeted. That's exactly what you see on this chart. But you would think because of the lockstep movement, that's what happened for ConstruTech. It did not. For ConstruTech, actually, there is no plummeting of the Series C plus growth rounds happening. We're still at 2x the size of the growth rounds that we were 10 years ago. It's relatively steady over the last 3 years, and it's always trending to the up and to the right. My explanation to that is it's a baseline effect. We were so underinvested in the growth rounds, and we have been finally seeing quality companies reaching the later stages that it was basically impossible to do smaller growth rounds, which is a good sign because it means that we're beginning to attract the capital also in the growth rounds that we should have. So in a few years from now, this chart might look different, but for now, it means we're a magnet for capital.
Yeah, I actually think that, but what do I know? I think that the reason for that, partial reason for that is that other tech, not construction tech, is focused on consumer, and where there you find lots of hype and less pragmatic approach, whereas construction, there is not that much hype, I think, and people are looking for a pragmatic approach that will deliver solution or outcomes. So that's why there's no spike like it is comparing to other technologies.
I love that explanation. Now, we do have anecdotal hypes or anecdotal examples of hype shit also in construction, but as a general observation, I think you're bang on.
Yeah. So I think also it might change when there's more consumer-related products, but that's perhaps difficult to imagine even, right, in construction. Maybe in the design space, perhaps, but that's still a kind of vertical within the whole construction space.
Yeah,
I think that's where the hype comes from, where you can have huge numbers of people
Yeah.
Buying stuff.
Yeah, FinTech was very hyped.
Yeah.
Anything basically that a generic investor brain would have a lot of that's what I keep saying. What a generic investor brain would have empathy for, they find it easier to pour money in.
Mm-hmm. What's the average round size right now that you can think of for early stage?
You mean, so for seed rounds, if you want the exact number, I would have to run the analysis, but anecdotally, I would say between US and Europe for a seed round, probably 4 to 5 US dollar. In Asia, it would be smaller. For Series A's and B's, there is no true average. It's a very wide range because at that point, the companies will depend less on narrative and less on, what should be the dilution? And it will be more about what is actually the substance in the business. So I would say probably the 80% distribution range for A and B rounds in US and Europe for A's, for Series A's specifically, maybe 6 to 20 would be my guess. 20 would be a very, very large one.
Mm-hmm. So you mentioned that in Asia would be smaller in terms of the early stage round. Then it's interesting because the market is much bigger. Obviously, I guess the cost to develop something, a tech, is smaller. But anyway, lots of Western startups would use Asian workforce to deliver the tech anyway.
It does happen.
Yes. So what I'm trying to get into is that the rounds are smaller, but the market is bigger. Why is that? Why they are smaller then?
In general, there is less capital available in the Asian markets than there is in the Western markets, and the Asian markets you typically require boots on the ground, and you require quite extensive experience with the local ecosystem, both the local customer markets as well as the local capital markets, and so the capital that is available in the Western world just only to a small degree actually has boots on the ground and has that empathy that is required. So we do, because we actually have an Asia team that grew up in Asia, that has boots on the ground in Asia, etc. And we dedicate also to our vertical. And there are Western funds that have that. There are Western funds who actually have spin-off brands that have boots in the ground in Asia. But if you look at it from a macro capital allocation, it's not to the same degree that, for example, it was in China 5 or 10 years ago. But I think we're getting there.
Mm-hmm. All right.
Should we talk a little bit about unicorns? It's always an interesting discussion. I suppose a bit more of a pop subject when you come to these kind of articles. But yeah, just reading what you have written here, Patrick, we still have, was it 14, 15 currently in the market?
Yeah, unfortunately, one went bust in July.
It was 17, I think, January, February, I think. Right?
Yeah, we had 2 bankruptcies of previous ConstruTech unicorns. The first one was Vive, and the second one just recently was Nexi.
Mm-hmm. That's probably another episode to discuss this.
Unicorns.
You should definitely invite someone from that company.
Mm-hmm.
From Nexicon?
Yeah, also Vive.
Working on it. Do we think? I guess. Are the numbers that we have just discussed an indication that more unicorns will come out of the industry?
Indirectly, not directly. So indirectly, I can already see from what's happening in the industry that we're growing quite a number of highly substantiated companies. A lot of the unicorns that you see here in the middle of the chart. So basically the way this chart works, if you can see it, is so in the middle, I map all the unicorns that are publicly known in ConstruTech AECS Tech. To the left, I move them when they get acquired or publicly listed. So Aconex, Procore, RIB Software, View fall into there. And to the right, I move them once they are basically dead pooled. So up until July, those were Katera and Vive as previous unicorns. Now I have to update the chart in July again because Nexi actually also is a prior unicorn that is now dead in the water. And so in the middle, we have the alive and private ones. And so here, for example, House, Kujale, Tobato, they are technically still unicorns as per public knowledge, but the last round is 5 years or more away. So it could either be because they're net profitable and the valuation is still justified, but it could also be that, hey, actually they're not doing very well. They are just being they're just being still alive, but perhaps the business is actually worse off than it was 2, 3, or 4 years ago when they were still considered unicorns. So for these, I cannot really say, which means, to answer your question, Owen, I think we're actually seeing a weed out of prior hype style unicorns. And the next unicorns that get minted will have a higher share of true substance to it. And that I can already anecdotally see is happening.
Yeah, how about Europe as well? There's still, I think I can see one flag.
Yeah, there's one.
France, aren't they?
Yeah.
Oh, it's Europe, but they are a French company.
No, it's France. You're exactly right.
I actually, you done a Practical Nerds episode on this a few months back. How do we view the European ecosystem for producing unicorn?
For renovation technology, and especially energetic renovation technology, I think it is producing 2, 3, or 4 potential candidates in the next years, with substance, not with hype. So that is certainly my expectation. There is 1 or 2 companies in B2B marketplaces for construction that I consider potentially worthwhile as unicorn candidates, again, because of substance. One of them I'm familiar with because I'm an investor that has, triple-digit GMV and is net profitable. That could be minted as a unicorn in the next, I would say, 3 years. When it comes to perhaps design software and software
can
for
you mention it, or you can't?
I'm not allowed to.
Fine.
When it comes to software for design and AE, there are good projects, but also to become a unicorn in that space, you have to truly rival the incumbents. And so that is a little early for me to say whether anyone across the world is going to get on that track, or whether it's more you rival features or parts of the suite, but not the entire company. So I don't know that yet. Overall, I think we're looking really up in Europe, but because of substance, not because of hype.
Mm-hmm.
Very good.
So speaking of unicorns and funding, and we should mention also, or maybe you could say something on exits. Are there more exits generated by IPOs, or perhaps other companies acquiring startups, or it is not the case? I remember I was chatting a while ago with a generic investor and asked him why they don't invest in construction technology. They said that there's lack of exits in the industry, and that was part of the reason. Is it going to change, you think, or not necessarily?
It's already changing. So you shouldn't judge the book by its cover, and the cover in this case is the exits that get covered by whatever Financial Times, Forbes, TechCrunch, etc. are typically the ones that are several hundred million, and then ideally IPOs. But actually, so first of all, overall in the world, we already in all venture spaces in the first 6 months, we already had 110 IPOs in technology in the US alone, right? So in general, exits are beginning to happen. Specifically to construction tech, we are seeing a lot of M&A, not always the M&A that VCs and founders necessarily would call the dream outcome. So anything between 10 to 200 million. I think it's actually quite liquid right now. And a lot of the more substantiated businesses that got funding the last 5, 6 to 10 years actually are on everybody's radar. Sorry, everybody, I mean private equity firms as well as strategic incumbents on their radar for a pipeline. It's the businesses that have raised a lot but actually have no substance in the business. They will not exit. They actually have a very, very dry exit market. So it's happening. And in fintech, financial services, we talked about it earlier. I mean, Autodesk bought PayApps for, I think, 490 million Aussie dollars. So about 300 million US. Just a few weeks ago, and Trimble bought FlashTrack in the same space. So actually, especially in financial services, perhaps we're currently seeing a liquid market.
Yeah, I think FlashTrack as well. I'm not sure the funding figures were announced, but we spoke with, the acquisition figure was announced, but we spoke with someone on Wednesday, and Man, do you remember the figure that was thrown out? I don't want to say something, but it was in the hundreds of millions.
I think it was something 200 or 700. I know it's a big shot.
Yeah,
For FlashTrack.
No, I'm not. I'm not. I shouldn't be saying anything. I don't remember.
It was Trimble's acquisition.
Yeah, Trimble acquired FlashTrack, but no, I would find that hard to believe.
Yeah. Okay. Last one from me on this particular topic, Patrick, would be, as an investor, when you do these kind of analyses, is there like a semantic or something that comes out the back of it? Is it like does it give you a good signal? Like how do you treat this information? Do you change the strategy about how you invest, or maybe talk to that if you can?
It's more to determine. So look, my business is backing horses on horse tracks. And this is not an analysis that I can use to pick horses, but it is an analysis to make sure I'm still visiting the right horse track. That's how I'm treating it.
Nice. Okay.
I was expecting some Wimbledon analogy, but horse track I find as well.
We got
Sorry, for you Brits, this must work, right? I always need to use tennis or horse tracks. Maybe polo.
I think. Oh, and Patrick's talking to you right now.
Yeah, you get. I think if we can.
Although
make one up, you'll be getting closer to the bullseye. Let's say.
Oh, that doesn't sound encouraging. You know what happened after someone said the bullseye comment recently? Anyway, we're not talking about politics.
No.
Okay, you guys not been on Twitter for a while, apparently.
No, not for 10 years, almost.
Okay. Any final comments, Patrick, on your article and maybe where we're going? I think we touched on it, but any final comments?
So look, we're with the 34 billion that we crossed, we're exactly on track to the pattern that we as Fundamental predicted 5 years ago, which is it will take us 6 to 8 years to get to 50 billion. So we're exactly on track.
Beautiful.
How about you, Martin?
And that is that is important because after 50 billion, sectors truly go boom. So from there, you typically go to 150 to 500. Sorry.
Okay.
Yeah.
You are asking me a question. What do I think?
Yeah.
Well, I'm watching. I'm enjoying watching the growth, and I'm enjoying providing journalism, commenting on this, and learning a lot. So yeah, happy days for me.
Okay, I was hoping for an analogy, but we'll take the journalism.
Oh, okay. Maybe next time. All right, let's move on to the last take, which is Didi Das said that many people ask, how do you know the next big startup to join? And apparently, based on his analysis, one should join a startup that has been growing their headcount in the last year or so, and you should look at the data of how many employees there were year ago, 2 years ago, and join the one which is growing the headcount the most. So, what do you guys think?
Oh, and you go first.
I think that maybe is this a case possibly of correlation rather than causation? Maybe that the two are correlated, but like you don't actually increase headcount. Like maybe I'm not 100% sure what I'm trying to say, but in my head it makes sense. And maybe this is how he's got to his figures.
I think that.
I mean, if you're looking at just because an increase in employees goes up. Who's saying you're not just getting loads of shit employees into your business and then
on 1% margin, running business on that 1% margin? Or in central startups, you don't have any margins anyway.
I don't know. I guess the point is it seems very more vanity based as opposed to Patrick, to steal a word you use a lot, substance based. So yeah, I genuinely can't see how it would be positive. At this stage, really.
Yeah. So I can say that obviously I don't have startup experience, but looking at from normal typical business point of view, if the headcount is growing, their expenses are growing, and usually margins are becoming tighter and tighter. And I can see lots of companies in construction having this problem. And now if you transform it to the technology, and startups in technology, you are in the business, you're growing your headcount, and you're obviously not profitable, which is fine in this industry, but your path to being profitable is probably becoming longer rather than shorter because of number of employees and the whole infrastructure within the business. So I'm probably biased, but I feel like this is completely not the right metric because it doesn't show what's the substance in the business like. By the number of employees, you cannot judge what's the substance, and if there is a substance in a business, really.
Plus, I would also say that I've been thinking about this quite a lot, and it was something I also thought about a lot in the past. Was if you're trying to attract the best talent to your company, then naturally the hiring process will take longer, right? Because you're not just going to interview and pick someone up after like a week of interviewing them. And I think the best companies obviously have the best employees, so their hiring process is probably a lot more stringent. They take their time as opposed to hiring fast. And so as a result of the sloth of hiring these people, the headcount is not going to increase at such a strong scale. And therefore, this guy is probably saying that that's not a great signal.
That's actually such an important point that you're making, Owen. So the usual phenomenon actually is that let's say the first 30 people that you hire into your business, if you're an exceptional founder team and you're very good at recruiting, your business is good, it's attracting the right talent. If you're very good at recruiting, you will increase the average quality of your team up until 30. Up until 100, if you're exceptionally good at attracting and at recruiting, at that point, if you're exceptional, you will maintain the quality of your people. Once you go, above 100 to 1,000, there's only so few companies in this world that actually have managed to increase the quality further. There are some talent pools that are supposedly like that. Plaid, for example, was supposed to be like that. Palantir, supposed to be like that. But most businesses, most technology companies actually will decrease the average quality once they go above 100 employees and further, which means so that has a few implications. First of all, when you're listening to Didi here, it actually means that most likely statistically, if you think this is good advice, you're going to lower the average than higher the average. Why? Because the person that is of super high quality will actually know to join only other super high quality people that are better than them or at least equal than them. But they still feel they are going to raise the average. So you have terrific people at the peak of the company that you want to join, but overall you feel like, hey, I can raise the average on this one, right? So actually the implication, if you think this is good advice, is think about what that means and what that says about you. So that's one. Two, Martin, to your point, so this, in my opinion, is an absolutely terrible signal, and it's unfortunately a signal that A, the venture industry uses a lot, especially VCs use a lot, and B, the venture industry is prone to hyping shit up, which means that actually they are making narratives by pumping companies up with money, whether there's substance or not, and it's then this pumping up with money that will drive recruiting. And that will create a self-perpetuating cycle of narrative if you are buying into it. So if you're the sucker that actually thinks, hey, just because a company is growing headcount, it's a great company, that's why I should invest my time. Your lifetime is more expensive than anyone's money. So I'm investing my lifetime now into it. You're actually falling prey to venture hyping shit up. What you should be doing is looking for substance. So you should not be falling prey to, hey, this is a press release, because everybody can write whatever they want in a press release. Hey, this is the fundraising numbers. This is the headcount growth. You should be looking for the substance kind of information. So pay attention to what customers and suppliers are doing in niche communities. If you have access to customers and suppliers and you can see what they say about a business, that's awesome. But even if you pay attention online, you can go into niche communities and see what they say. Two, if you had access to P&L and cash flow numbers, that would be the true substance. But even if you don't don't look at headcount growth. Just look at what kind of quality. What was the last person that joined the company, and how would you rate their quality? And if it's a true A+ talent, then you can be damn sure that that person actually requested access to the P&L, to the cash flow statement, and to the customers and suppliers, because an AAA talent will not invest their lifetime without doing that level of diligence. It's actually oftentimes more diligent than Didi and the likes would be doing on many of their companies. So pay attention to the quality of the last person that joined.
Mm-hmm.
I love the take.
Yes.
Thanks.
I was going to say amen.
Yeah.
I mean, what else to say on this? I think I was just looking
I think you
at
said enough.
I think I was looking at the Snowflake, for example, as I've been watching the stock price for maybe a year and a half now, and actually, obviously, it's not a good metric as well to compare the current stock price to the number of employees. But even if the business is increasing the number of employees, the stock price is not reflecting it. It's actually the other way around. So maybe you will see, and I think there were some layoffs in Snowflake on an example of this particular business. So it's probably also the headcount can be actually a metric of how a business is overshooting and not efficiently allocating resources rather than how good it is. Yeah.
Yes. It's not a signal of quality.
Yeah.
It doesn't mean it's the counter signal. It's just not a usable signal.
Yeah.
And by the way, you can see here, I find it funny. So you can see that there's one line right below a firm that might have been deleted. It could also be an honest mistake. So I wonder if that was actually something like CrowdStrike or something like that, because it didn't fit the narrative.
Very good. Okay, guys. So shall we wrap up?
Yeah. I have 4 notifications to check who wrote.
Oh yeah, you best go then. This is a strong signal that you are gaining popularity on LinkedIn.
100%. Oh, it's number 5 now.
Oh, it's 5. You're exploding.
Is it live? Sorry, guys. Is it live?
Okay, guys. Okay, well, thank you. We'll see you next week. Yeah.
All right. Thank you, guys.